afternoon. Today, we're pleased to welcome back Attacq to Unlock the Stock. This platform was created for retail investors to connect with corporate management and to get a better understanding of them and their companies. We are joined today by Jackie van Niekerk, the CEO, and Keyter de Villiers, the Interim CFO of Attacq, who will take you through a presentation in a short while. Unlock the Stock is only possible with our technology partner, Lumi Global. You can visit their website at lumiglobal.com to learn more about their various online AGM and investor presentation solutions. The Q&A session will be hosted by the Finance Ghost and Mark Tobin of Coffee Microcaps. Before we start, we have a few housekeeping notes. The company presentation will be followed by Q&A. You can post your questions by typing them into the chat box, which is at the bottom of your screen. The event is being recorded and will be available on our YouTube channel soon. You will also see an email address when we begin the Q&A session. Please take note of it if you want to be added to Attacq's investor distribution list. I am now going to hand you over to Jackie and Keyter, who are going to take you through the presentation. So we are ready for you guys to share your screen, please, and go ahead with the presentation. Thank you.
Thank you so much for that introduction, and good afternoon to everyone. I hope everyone can see the screen. We've asked the team to just do a snapshot, not just of year one of Attacq. We've just recently released our interim results for December, but just maybe taking a step further back. We're a listed company on the JSE and the A2X, and when we went further back, I asked the team to run our compounded annual growth rate in our distributable income per share, and we have got a growth rate of about 23.3% maintained over the last year. Our portfolio value is over 22 billion. We pride ourselves of being big difference between ourselves and other REITs, where we a precinct developer and owner. So the differentiating factor for us is we really don't focus on a lot of assets throughout South Africa, but more focused on diversified assets within precincts. And I'll take you through some of our precincts that we've got in our portfolio. Our portfolio is well diversified in our precincts, and we're a South African only fund. Our 5-year average of occupancy maintained is just under 93%, and we're working very hard to maintain it at a 95%. And with collections over 100%, we can't pay our dividends if we don't collect all our rent. So really important for us is to ensure that we collect all of our money. Waterfall Developments has been a cornerstone of our business, and it was also the catalyst for us listing the business about 13 years ago. We bought just over 2.2 million square meters of bulk, and proudly we've worked our way through half of the bulk, but still sitting with 1 million square meters left in our portfolio, really being the growth driver and engine in our business with the developments we bring online. Our gearing to date, our gearing metrics is 25.1%, and our interest cover ratio 3.15%. And people go through, just take again further 5 years back of where those debt metrics were and how proud we are of where we are today by deleveraging our balance sheet substantially through certain transactions. Going to our energy mix, and a few years ago, load shedding was very topical. We had a lot of load shedding, and we accelerated our rooftop solar PV program. Currently, our green energy mix is 10.9%, with an aim to achieve 25% in the new few years. Your question would be, how would you achieve it? So we've pretty much almost exhausted all of our space, roof space on our roofs. We have also signed a power purchase agreement, which will come in effect towards the end of this year, which will afford us the opportunity to increase our green energy in our business to over 25%. Now, what's more topical is water and water backup, especially trading and operating a substantial part of our portfolio in Gauteng and Joburg in particular, where we also again made a call a few years ago to substantially increase our water backup in our portfolio. So 68% of our portfolio currently runs off 5-day water backup. we're a very well diversified portfolio, and I'm very proud to say that the females dominate a bit more than the male in our portfolio of the 162 employees, and maintaining a level 1B score, which again we're very proud of. As I said, you can see we're a South African only fund. Over the number of years, we've cleaned up our offshore investment, and that was really a strategic component for us, is to say that let's focus in our control, what's in our control, and that's in South Africa, with the growth driver being Waterfall City. But within the South African portfolio, we've got a vast range of assets. Retail experience hubs, that's retail dominant shopping centers throughout South Africa. Collaboration hubs, if you're not familiar with the Attacq terms, that's the term of office. Post-COVID, we said the office has really got a new term. You come to the office to collaborate. Logistics hubs, and we're very proud of the new land that we have opened and unlocked for logistics developments. We'll show you in the portfolio. Hotel developments, other developments. That yellow block represents data centers. Again, very proud that we are 50% shareholder of 2 data centers, and we've got 3 still to build in our portfolio with a JV company called Vantage. And then we've got our leasehold land and other developments under construction. If we go through our strategy, just to stand still on what is the focus points in our business. Precinct focused landlord, as I said, really for us a big focus, not being everything to everyone, but really developing skill and management skill in our business to not just manage the asset, but the curb, the experience. If you take the turnoff on Allendale, the electricity, the macro infrastructure, and I really believe that in Joburg has been a differentiating factor for us in selling space. We're also looking at upgrading certain of our other precincts in the rest of South Africa with great learnings that we've achieved by upgrading Waterfall Mall in Potchefstroom. That mall now being fully lit, and with extensive upgrades of our the tenants in that particular portfolio. Our continued growth, our aim is just to achieve market average or above market average NOI growth. Yes, really discipline in the detail of, what's the cost of our growth, of our expenses, the top line, the escalations that we achieve, focusing on a quality portfolio, but also quality earnings. In Attacq, we talk a lot about sustainability. I believe that the relationship between client and the landlord must be of a sustainable nature. So our leasing strategy is vitally important in achieving sustainability and also a high covenant lease profile in our portfolio. Our energy initiatives, and then the cost containment, as I've said, we place a lot of focus on that. And then I also believe that in Attacq, with having a precinct focus, we do get the economy of scale through our SLAs that we sign with our certain suppliers. Now, with a property portfolio of this size, and also focusing on our people, we also need to ensure that do we have scalability and efficiencies in our portfolio. We've embarked on a big approach to upgrade our systems. Pete is busy with that, a big project. We'll be overhauling our ERP system, really with the aim to advance our staff, to get better efficiencies and scalability in our business. The last component of our strategy, really, I would say, is one of the most important parts, is the capital allocation strategy. Where is the capital going, and is it going to at best work? Our capital structure is very important. So our first part is the developments at Waterfall, and it must be commensurate to a market-related yield. And Pete will go through what is those yields that we're currently developing at. Our current reinvestment back into our portfolio. I've said there's some upgrades that we are doing in our portfolio. And again, that is creating that long-term sustainability in our portfolio. And then there is some small disposals that we are considering. And the last component of our capital structure is definitely the debt strategy, which the team has done substantial work and has been very successful in driving the cost of debt down over the last few years. Pete, maybe you can go through the share price.
Yeah, sure, Jackie. Thanks very much. So what we've shown on the screen there is a share price or relative share price graph of the Attacq share price versus the J253 index. It runs from March 2021 to February this year, so around about 5 years. I think obviously in looking at these things, a number of things to point out. First point would be January 2021 was not a happy time in the property industry. It was a time of significant distress. So obviously during lockdowns and COVID, etc., and that the property sector and ourselves as Attacq suffered greatly from a share price perspective during that time. I think we suffered more than the rest of the sector, though. That would have been a function of going into the lockdown cycle with higher debt metrics than many of our peers, and that's not necessarily that's more a function of if you look at Attaqq's history, first listing in 2013 as a capital growth fund and only converting to a REIT in 2018, and capital structure is something that takes a long time to change, and for all that we've made a large number of improvements in our capital structure prior to going into lockdowns and the like. Unfortunately, there was still work to be done, and the market definitely punished us. If we look at the phenomenal growth after that, it took a bit of time you'll see there's a lot of mud along with the sector and ourselves and our share prices. We're just moving sideways on a very low number. Then there's a bit of a tick up in the Attacq share price. That would have been mid-2023. And the catalyst for that would have been us announcing the GPF transaction, in terms of which the GPF injected 2.9 billion into acquiring a 30% stake in REIT. What we did with that money is we put it all into debt in the group. And that was literally a huge benefit to our capital structure. Jackie's mentioned some of that already, but if you look at the earnings growth below on our dips, a large function of that is because we paid off a lot of debt. That also allowed us to refinance all of our debt at significantly lower margins, and ultimately also allowed us to enter the DMTN market at again further lower margins. So all of those things adding significantly to the bottom line. There were some other initiatives over the period as well. What we did, for instance, we used to have a stake in a company called MAS. MAS turned off its dividends during lockdowns and never resumed them. We then took the opportunity to sell our MAS shares and reinvest them in buying the 20% stake in the Mall of Africa that we didn't own, that had been closed at the end of 2024. So a number of initiatives. Further one would have been us selling off our stake in the rest of Africa. It was never giving us any income. It was actually requiring some capital to be injected from time to time. So we turned that bleed off and swapped it for shares in Langer. So it was largely a function of, throughout the process, very disciplined management, trying to drive rentals, trying to fill vacancies, cost control. All those initiatives obviously will remain. That's our bread and butter, but definitely pulling some levers to convert non-income producing assets into income producing assets, to substantially improve our capital structure and take advantage of all the benefits that flow from there. As can be seen, our distributable income per share grew from 40 or just under 47 cents per share to 120 cents we forecast for the full financial year going forward.
Right. Now, standing a bit still on the South African portfolio, and I spoke about our precinct approach. So we have got 6 precincts in our business, really focused on the dominance of these precincts, where they trade, the attractiveness, the relevance, to continually attract shoppers, people, community to all of our properties. I spoke about Waterfall Mall is situated in Potchefstroom, recently upgraded this particular mall. It's got almost a 0% vacancy. Really proud of what the team has achieved, and we're continually also looking at the green metrics to improve the green energy in that particular building. We then go over to our Mall of Africa. Mall of Africa is situated within the greater precinct of Waterfall. Waterfall being the big catalyst for us, but Mall of Africa being the anchor of the Waterfall precinct. It's over 130,000 square meters. It's 10 years old. I can't believe it. We're busy with the 10-year renewals. A question might be, how is it going with the 10-year renewals? We have seen positive reversion in most of the rentals. We just over halfway through renewing all the rentals. So we've really seen some great expansions of clients, and then also we are very happy to say that we are currently looking at Walmart taking over the game space. Attacq Mall is a precinct that is a combination of office and also retail in the heart of Stellenbosch. A really interesting precinct to manage. If you've got parking, you are the most prized asset in that portfolio. One of the assets we're looking at upgrading and also improving on the parking ratio in Attacq, really fulfilling that need for the community. Then Gordon Mall in the Southern Cape. If you're on holiday in George or in that area, you probably would have run in there for a late Christmas gift at Gordon Mall. We've also benefited with this immigration to the Southern Cape, with people establishing themselves more permanently in the Gordon area. That mall trading very well. Also very, very low vacancies, almost no vacancies maintained over the number of years. Limit Breach precinct in Glenview Boulevard, that is a precinct in Pretoria. It's also anchored with a beautiful theatre that is run there. And really a combination of very strong office leasing, some convenience, restaurants, theatre, and then a convenient shopping centre anchoring the Limit Breach precinct. And I think this is one of the few assets in the country that has got direct access onto the N3. So it's a wonderful asset. You don't sit in traffic. Then if we go, I've spoken about, we pride ourselves in our covenant and with the type of clients. So within our portfolio, you've got sectorial diversification, and then this is illustrating further than that in Waterfall, we have got industry diversification. And this really held very true when we went through COVID 5 years ago, where certain of our clients was in strain, but a lot of our clients weren't, that could operate from home, that could continue to pay our rent. And this just illustrates not just the quality and the exceptional quality of international, multinational clients we have, but also the sectorial split that we have in our portfolio. And you'll note that we're very, very famous for health and pharmaceuticals. I think the team is running with 2 more pharmaceutical companies to be situated here, and then also engineering and our services. We see that they quite like Waterfall. I spoke about our water backup and our greening of our portfolio. You'll see our water backup that we have ramped up the backup over the number of 3 years quite extensively. Strategic decision in our portfolio, and we believe resilience is key, and we're almost starting to talk about what does water resilience or water independent mean for us as a business. Over February, we had a 10-day water outage here in Waterfall. In the evenings, they had some trickle feed back into our systems. All of our systems and backup systems was already installed, and I can proudly say within the 10 days, we could trade, the Mall of Africa could trade. We had no interruption at any one of our hotels, and the lowest level one of our tanks went to was 62%. Now that just illustrates that as a business, we think about the future, we're proactive, and we also work with council on the macro infrastructure of our business to ensure that our tenants can always trade within our buildings and get quality occupation within our portfolio. Stepping over to the developments. Oh, this is just a nice illustrative of our precinct management. You'll see we're very busy from opening international brands, PV installation. One of very close to my heart, a activation we did was for Heritage Month called Heritage, winning some really cool awards, but really to the essence of understanding the community. And I think that's why it's so close to my heart, and a various number of initiatives within the portfolio. Now stepping over to developments. I'm not going to stand still. I've spoken about this. This map shows you the whole of Waterfall. Now this is all of the Mia land, that is the leasehold land. We have not developed all of it. Some of it was developed by Baldwin and Century City. The coloured in and the highlighted areas is still the vacant land, the 1 million square meters that we have got left to develop. And you'll see the big red component on your screen. That is the logistics warehouse land that we have recently opened up. That was a long process that we had to undertake with council. We opened up, we built a water pipeline, we built connections, and now we've got over 600,000 square meters of logistics land, of which 400,000 is ready to go. Currently, we've got 40,000 under construction within 2 warehouses, one a speculative warehouse and another client-led development. This is just Waterfall City, and also the value proposition that we talk about, the locality. It's in the middle of Gauteng, and I'll show you on the next slide. Safety component, extremely important. Over 400 cameras in the city, guarding, patrolling, sustainability we've spoken about, infrastructure. This is really a place where we pride ourselves in world-class infrastructure, roads, and all of the amenities that we built. Now we can go to the next slide. If we talk about why is Waterfall so special, it's in the middle, in the heart of Gauteng. So all of our major roads, is very close. So we've got the N1 that passes through Waterfall City. We also look at journey to work. So anywhere where you sit in Gauteng, this is the center of gravity for people to have the shortest distance or travel time to work. And I think that is why it's such a compelling place for our tenants to come and occupy office space. We've also seen that because of the proximity between Johannesburg and Pretoria, that the office consolidation theory holds very true. You don't need two offices, you consolidate it into one office. PwC consolidating offices, Deloitte's consolidating offices, DP World consolidating offices here. Really the theory holding true of being in the middle of Gauteng, easy access, and then cost saving for our major corporates. This is another illustrative just to show everything that is colored in is built or currently under construction or being planned, and just seeing that it is how we've rolled out our infrastructure, where the roads have been built, where the bridges have been built, where the infrastructure is in, and that's how we're rolling out the Waterfall infrastructure. We're very, very much aware of not wanting to have too much high land holding costs, and through a phased approach, we roll out Waterfall City. Pete, maybe you can just go through the yields and all the current developments that we got under construction.
So I'm going to talk to you the chart on the bottom, which lays out our effective share of development activity. So the total development activity is in approximately 2.1 billion and about 90,000 squares of developments. We, however, have obviously JV partners in some of these assets. So we talked to about 1.3 billion of this, and around about 50,000 of it. So just under 50,000. So starting on the far left, Gateway East, that's a new office development which you've greenlit. Those of you familiar with Waterfall City, when you drive in and you see the sculptures of the two Africa sculptures at the main entrance to Waterfall City, on the left-hand side as you're facing the building, there's quite a large structure under development at the moment. We're about to top out. And that's a 12,000 square meter office development, of which the bottom floor, about 2,000 square meters, is going to be restaurants. The rest is going to be all offices. They actually greenlit on the back of another office development, which we completed last year, April, called the Ingress. That was a 5,000 square office development. That was fully let before it was finally completed. So based on the success of that, I think we're happy to say, and just the success of our other office products, especially close to the mall, office is not dead, contrary to some belief. It's in a slower measured pace. And we launched this Gateway East product to take advantage of that demand. And as things stand now, it's about 33% let, and we've still got quite a way to go. So we think it's going quite well. Then if we look at moving along the right, we've got a client-led warehouse and what we call the LP3 spec warehouse. That would have been, just referring back to Jackie when she talked to the waterfall map, those red, that big red area, the northernmost red area would be phase 1, and these are taking place there. We've also got a smaller development on the side of the mall, Pantry. We're quite excited about that. We had the opportunity to redevelop 2 existing taxi transportation facilities. What we've done is we've centralized them under the mall in space that we've already got, which was constructed when the entire Mall of Africa was built. So we've created not only a brand new world-class sizable taxable facility, which now caters to the growing demand and passengers that's coming to Waterfall City. We're taking the opportunity to redevelop the space on the western side of the mall into a pantry, and that should hopefully open towards the end of this calendar year. We've also got a hotel and conference center, which we're going to build on the one side of the mall, on the eastern side of the mall. So it's going to tie in seamlessly into the mall. It talks to building amenities and bringing other uses into the precinct. It's 180 rooms. It's got about a 6,000 or 6,500 conference facility. So we're targeting the smaller conferences, expos, and the likes that need about 1,000 participants. We think it's an underserviced space. There's definitely demand for it. And we've got 75% of that development. The other 25% is owned by a preeminent property developer. And hopefully we can announce that in the next few days. But I think it's a nice stamp of approval on Waterfall as a precinct in Waterfall City and what we're doing here. Then we've also launched Aspire Residential. That's decided much opposite the pantry. So we're quite excited about how that entire street front is now going to be activated. That's a 220 unit residential development. As things stand, it's about almost 70% pre-sold. So we're extremely satisfied with how that's been going. That's obviously launched on the back of the recently completed Ellipse developments. A tried and trusted partnership, and we feel we've got a very attractive product given the success that we've achieved to date in the nature of these developments. I think if we talk about numbers though, we generally target an initial yield or a gross yield of between 8.5% and 9%. That is what we're achieving on all of these developments. I think what's important though for investors to realize, and maybe not everyone does, our land is already paid for. So when we quote that yield, it includes the land, which is essentially that development before we take it to our investment committee or board for approval and a go ahead to greenlight the development. We put that land in at market value. So it's not in at zero value, or it's not in at any value. We feel it goes in at the market value of that land, and then we're still achieving those yields. So the point is that the cash on cash yield or the incremental yield for each of these developments will be slightly higher, maybe about 50 to 100 basis points higher. And that means that these investments, when they come on, are all mildly accretive from a distributable income perspective. And then given one or two escalations, then they start adding significantly to the bottom line. So that's where our growth comes from. That's where we can unlock these developments in a very responsible manner. You would have noted I have used the term spec on two of these developments. It's always going to be applied in a very measured, considered approach. We're not going to be building based on demand and how we see the market, and we always take into account what's the greater node, what's the economy, what's the underlying demand, where are the other risks in our portfolio. But if the demand is there, then it's a nice growth engine for us to add a bit of growth every year and continuously grow our distributable income per share.
Right. Then just some illustrative purposes of what Peter's spoken about. You'll see here next to the PwC tower, this blue facade that is dropped in, that's the talent conference. Then there on the other side where Ellipse is the pool area, that's obviously the residence of Aspire. And then towards the further side of the mall, you can see the gateway development going up. Just really nice to see how the development is growing. This is just again showing Waterfall Junction. That's that red area that I showed on the previous map. How we unlock the Waterfall Junction, and it's just the illustrative where it's situated on the map. Then lastly, we talk a lot about infrastructure and how we pride ourselves, and we're really busy with infrastructure. The other day I counted collectively in this area, it's hundreds of millions of rands that has been spent, luckily not by us. But currently we are busy in building upgrading the Waterfall entrance to the city. That is happening at Gateway. We've got the LP site, sale of the LP12 site, that's called through that sale, able to build and construct the third and very important entrance to Waterfall City. And then we've got the K60 that's currently being constructed, and that's not by us. We've got a watching brief over, but that's Province that is currently constructing that. And that's basically connecting all the way from Sunninghill to Allendale, a further road, which again opens up the city and has got another very, very important road connecting Waterfall to us. Then we're going to step over, and change to just the debt metrics and the funding metrics. I spoke about the journey of the funding metrics. Pete, you can maybe, you've said a lot, but there's some more to say.
Yeah, I think this puts it in perspective again. We're looking at the top chart, the bar chart. That gives some of our key debt metrics over a time series from until December 25. The metrics presented there are interest cover ratio, which was starting at around about 1.41 times in June 2021. over the time series has now improved to 3.15 times, so one of the best in the sector. Again, our LTV, our loan to value, in other words, the value of our debt to our properties and our assets, 43%. Now we've gotten that down to 25%, given all the initiatives that I mentioned earlier. And our debt margin has come down phenomenally from 2.06. It was 2.06%. That was the margin charge above Java on our debt. We've now got it down to 1.48, and hopefully can get it down a little bit more if the conditions hold. Our available liquidity stands at 1.5 billion as of December. Of that, 900 million is cash and 600 million is available facilities. And our funding mix is presented on the right. We've got a small DMTN program which speaks to about 11% of our total debt book. Then we've got bilateral banking relationships with RMB, Standard Bank, Nedbank. We've got 2 institutions in the form of Sanlam and Old Mutual involved. What we are looking at doing going forward, we tapped the DMTN market in October 2024. That was a natural consequence of our improved capital structure and getting our interest cover ratio up significantly, that we could access that market, and we are looking to access that market in the near future. That will be the main manner in which we fund that development pipeline, which we chatted about earlier. So pointing out just some metrics here, our weighted average term of loan term has come down by 6 months from June as expected. We haven't done any new refis during the 6 months, so that's the expiry of time. We're still very highly hedged at just under 85%. We would have liked to have maybe been lower hedged had we been going into a softening cycle as we would have expected until some conflicts broke out in the Middle East. But our policy is to be at least 70% hedged, and at least we are fairly well hedged if there's going to be a bit of a tightening cycle. Hopefully there's not going to be. Our weighted average cost of debt, including our hedging costs, has come down over the period from 9.2 to 8.9. That's a bit of impact from the underlying base rate still dropping, and some impact of some hedges rolling off. Gearing, as I mentioned, 25.1%, so no significant improvement in the last 6 months, but certainly a significant improvement over the last 5 years. Presented below is just our debt and hedge maturity. I think the nice thing there is we've worked a lot on this maturity and will continue to do so. It's always an ever-evolving process, but in the next 12 months, at least we don't have any new debt maturing. And then even in the 13 to 24 months, from a debt perspective, 885 million maturing, which is certainly manageable. Got quite a large number of hedges rolling off over those 24 months, and we'll deal with them on an ad hoc basis, but always maintaining our 70% hedging policy.
Thank you. We're very happy to step off the presentation and open up for Q&A. Thanks, Pete.
Thank you so much. That was a lovely overview, and I am now going to hand over the Q&A to the Finance Ghost and to Mark Tobin. If you haven't popped your questions into the chat box, please do so now. But over to, I think the Finance Ghost is going first.
Yeah, thank you, Vanessa. Thank you, Jackie. Thank you, Peter, for being on Unlock the Stock as always. And to all the attendees, please do keep those questions coming in the DMs. I'm going to start with just a relatively high-level one about the portfolio. If I looked at the recent numbers, strong growth in Waterfall City, maybe some pressure in distributable income coming from the rest of the portfolio. It's amazing how many people associate you with Waterfall, right? But if you actually look at the numbers, it's a pretty even split, which is interesting. So I guess the question is just non-core assets in the rest of the portfolio, to the extent you can talk about it. Should investors think about this, that you're going to increase your concentration to Waterfall going forward, or decrease your concentration? Maybe that's the safest way to ask it, and for you to be able to comment on it.
Maybe to take that. I think obviously the most significant part of our pipeline does sit in Waterfall, so that's going to be the area of natural accretion over time. Obviously, that's all based on hopefully a responsible build out underpinned by demand and such. We do look around from time to time, but haven't found anything compelling to invest in the rest of South Africa. We're certainly not looking overseas at the moment. We're proud to be at the moment a South African focused fund. Where we would see some maybe accretion outside of Waterfall would be if we conduct some redevelopments on our regional mall portfolio. There are definitely 2 or 3 opportunities there, which we'll probably roll out and evaluate over the next few years. So that will see some meaningful growth, but it's not going to be to the extent that we have to build out Waterfall. Obviously, there's sizable opportunity to do that. Then just in terms of non-core assets, our strategy as a precinct owner, manager, developer is exactly that, to focus on precincts. So we do have 1 or 2 assets which don't tick those boxes entirely. One would be our 25% stake in Brooklyn Mall. We partner there with another listed REIT, but we are essentially the minority there. So that naturally is not somewhere where we would be looking to invest and grow. And then we've also got an office park right next door to that, Brooklyn Bridge. Also being that it's not really a precinct to us. So we would prefer to focus our attention and our capital on precincts that we own outright and control outright.
Peter, Jackie, thanks again for joining us. I just want to touch on the the big step up we saw in the water investments, and just maybe understand. Obviously, you're trying to reduce operational risk for the tenants, but from a capital perspective, like how do you think about how this costs get recovered? Can you recover anything from the tenants, or is it just future-proofing assets and it's an investment in the asset that should it ever be sold, or it's more of an asset investment rather than something that you're putting in that you can recover from tenants down the line? It's kind of a different conversation maybe to putting solar on top of a building.
Yeah, well, solar's got a fantastic return. At this time, I'm trying to see the return comes out of water. So, Mark, firstly, what do we do with our buildings? I think that's the first part. So we always build water tanks at our buildings and 48-hour backup. So we said let's increase that to a 5-day backup water capability. We then also looked at and said, okay, if we can increase the water backup, how do we become better at the consumption side of our building? So taps, flow, restricting flow, so because if you make the consumption less, your water and sewer bill also naturally reduces in the buildings. I've got a happy tenant, but then there's also cases that we don't recover all of the water through common area in the building. So naturally, we also save money as a client. Then we also install digital meters and loggers. Now, that's been the biggest CP, I would say, where the money literally flows into the ground, where as a landlord, you don't sometimes know where there is certain water leaks or inefficiencies in your infrastructure of your piping. Now, that we've also spent some money on digitalizing that system, putting water leak loggers in place. That has saved us as landlord millions of rands by being more proactive, understanding, where the waters are. So most of our investment has been in capital in nature, but it's done, and that is also the spec that when we build buildings, that is our standard spec now. 5-day backup water, consumption focused, digital metering. Now that doesn't turn the investment away, but we are able to be more proactive and water wise with our clients on a proactive basis. So that's how we've basically applied it. And then a client would come and say, what is your water backup? So they'll choose us rather than another landlord because we do have that facility. So we've seen that we've achieved our market rentals in our office space have grown over the last 3 years. We achieved 7% plus escalation. So it's not something that I can measure on a direct return like solar, but I can definitely see the value is there for our clients and for ourselves as a landlord.
Okay, my turn to jump in. We've seen some nice positive valuation movements in your collaboration hubs, which the rest of us plebs just call office, of course, for anyone who's not sure with your terms. So that's in the green, which is nice. That's encouraging. Occupancy rates, I had a note here, still at like 88.5% roughly. Where do you think the steady state will actually be on this? I mean, office property has obviously been an incredible journey post-COVID around demand, supply, premium and A grade versus what's happened further down. So I think just any insights you've got there into where you think it can get to.
100%, Pete.
Yeah.
The default answer.
Yeah.
absolutely right. I think, yeah, we obviously below 90 in terms of occupancy. I think it's worthwhile for us just addressing that from our experience of the asset class. Obviously, we come through a stage where tenants are finding out what's the new normal. Is it 5 days back in the office? Is it 3 days back in the office? Is it 2 days? Is it hybrid? How does it work? We're definitely seeing a push back to the office. We see it in our engagements with tenants. We see it in the traffic. We actually like traffic. That means people are back at work and no longer sitting at home. We obviously need to believe in the asset class, but we also think the office is a space literally where people collaborate, learn, share ideas, and aren't just interacting on a screen 24/7. From our perspective, sub 90 seems ominous, but just to put some context to that, of our office vacancies, we sit at 30,000 squares that was printed at 31 December. 15,000 squares of those sit in what was originally, when it was initially built, the old Group 5 building. And then that was tenanted. So a large single tenanted building of 24,000 squares, 15,000 of those are vacant. Was then Group 5, obviously, you know what happened to them. They unfortunately didn't make it, went into business rescue and liquidation. It was then tenanted by Transnet for, I think, 3 or 4 years. And after that, we took the decision to multi-let the building. With that, it means that obviously some capex, some time required, but there is also I would say a challenge, but there's a natural limit on the size of the tenant that we can accommodate. The floor plate there pretty much can't go below 1,000 square meters. So you naturally cut out a lot of your smaller users. If we look at our other office products up around the mall, smaller office parks where the buildings are set up between 4,000 and 6,000 and multi-let, that product has actually been leasing very well, filling up very well. If we get vacancies, we often fill them before the one tenant's even vacated. So our vacancies closer to the mall are extremely low. That product is definitely in demand, and we've been seeing rising net rentals for probably the last 3 or 4 financial periods, which is it's pleasing to see that the office is certainly not dead.
Keyter, maybe this is one for you, but Jackie, jump in if you want to. I know you had a very detailed slide in the deck there now that we went through on, the debt journey over the last like 7 or 8 years. And I mean, I think it maybe might fair to say, as the pendulum has swung completely the other side, where 25% would be on the low side of REITs if we kind of look across the board. So maybe just, I'm going to preface this by saying what we've seen in, rates over the last 12 or 18 months, even at the government level, which obviously flows down through capital markets, and, going from 11 down to 8. Okay, I haven't looked at it recently since the macro environment has become more volatile, but it's still probably way down at where it was 18 months ago. So maybe just a thought on, bringing refinancings forwards, doing another note program to take advantage of, the kind of compression in rates that we've seen, or, kind of gearing back up a bit, maybe to 25, from the 25 to 30, which would still put you at the kind of lower end of the industry, but how that all, comes into the kind of capital structure mix that you're thinking of going forward.
I think first of all,
I appreciate that's a good question. Sorry.
I think sharing our debt journey, when one could get a sense of how hard we've worked to achieve these debt metrics. It's been a multi-year process. So we're certainly not going to just gear up and say not develop Waterfall, take the rails off and build things and hope they fill up and blow our balance sheet in that way. We need to spend every rand, every land of leverage that we put on the balance sheet has to work. As you can see, we've got quite a sizable development pipeline of what we think are extremely high quality developments, which will be accretive from day one. So we'd like to, if we do gear up as we go up, it's natural that if we are taking advantage of the demand that's there, we will gear up, and we'll have to wait for. At the moment, as you build out, there's not a lot of development profit in completing a building. So you do need to wait for 1 or 2 escalations to come through for your asset value to also accrete, and then to bring your LTVs down. So that's going to be our strategy, is to do that in a responsible manner. At the moment, we also only pay out 80% of our dividends. We also get questions from that front. Why don't you pay out 100%? Your balance sheet can handle it. I think the point is, though, this is an asset class that requires maintenance to be put in. We pride ourselves on the state in which we keep our buildings. We hope that helps retain our tenants and helps attract the rentals that we do achieve. So we do need to continuously reinvest, and we would not think ourselves as being good stewards of this balance sheet if we were drawing down on debt to paint a building or something like that. So we like reinvesting some of our income in that. I think from a REIT perspective, to pay out 100% year after year after year, it might work for some of the time, but it's not going to work for all of the time. So as to what other initiatives, we actually conducted quite a large refi at the end of our last financial year, so that we pushed out a lot of those refis on a bilateral basis. We are looking at going back to the DMTN market now. The yields are still quite keen. There is quite a lot of capital chasing listed bonds, and hopefully we can tap into that if the market holds out for another few weeks. And we're looking to raise in the region of another 750 to $1 billion. If that can bring our margins down, and it should, as all things stand, that's great. And we'll take it from there. But it's certainly not going to be an aggressive ramp up in LTVs. It must always make sense. Part of our ability to access the debt capital markets at keener yields is having good credit metrics. So as I say, we've worked hard to get to this point, and we want to keep that relationship with the debt capital markets going forward, build a track record, and issue as and when required to build out accretive DI accretive investments.
I'm going to jump in there with a question then around the retail side of your portfolio. And specifically, just because it's been so interesting to see what's going on, obviously, in e-commerce and omni-channel and all the rest. So two questions, I suppose, linked to that. One, do the turnover clauses at the shopping centers actually protect you? So when it's omni-channel fulfilled from a Checkers in one of your malls, do you get a piece of that? And then second question is, does your logistics exposure actually give you upside? Because presumably what happens in e-commerce and omni-channel is logistics space becomes more important over time.
Yeah, so every lease has got their own nuance, but yeah, our mandate to our teams is if you fulfill from our store, we get the turnover from what you fulfill. If it goes a Checkers 60/60 packet or in a Checkers different packet, you still fulfill from that store. So that definitely holds true. Our philosophy is that omnichannel is here to stay. So I think we should embrace the omnichannel as a team, and we really focus on understanding the client, understanding Checkers, understanding Villiers, understanding H&M, all of our clients, and where's your pressure points? Where's your focus going to be in your business? Are you driving it more online? Are you just driving a display store? What is your strategy? We've definitely seen that again, post-COVID, a lot of learnings come from more remains a place of gathering, a place where people want to come and sit and eat. We see great growth coming out of our restaurants, our takeaways, people coming together to do things together, entertainment options. So we really look at our malls as a hub, then saying what is the categories and what will continually bring people here. Part of Waterfall's attractiveness and Mall of Africa's attractiveness is we continue also building the collaboration hubs around. So we keep on bringing people onto the doorstep of Mall of Africa. So it's definitely a ecosystem that keeps on moving, keeps on evolving. And I'll as a team, as we're saying, don't shy away from it, understand it, embrace it, involve it. If we need to have more micro-fulfillment centers at our shopping centers, we'll do it. And then we've got logistics that plays into the other side, which is, do you need more fulfillment space? So we built the Cotton On space where it's the logistics fulfillment area, and also their warehouse. They were inefficient in getting their online out quick enough, and we built them a new facility, and the teams designed the fulfillment there, and they've definitely seen more efficiencies coming out of their business. So we play in both categories, we don't shy away, accept it and embrace it, and work with your clients to create that magic experience what retail always needs to be.
Another question, Peter, Jackie, whichever one who wants to answer them. obviously, you know, despite the great performances you alluded to, I mean, you're still trading at a discount to NAV. So maybe just some comments on, you know, upping distributions, because I mean the AHI is. I appreciate Peter's comments on there's still a bit of flex there. I think in terms of distribution payout ratios versus, you know, share buybacks, and just maybe a bit of comment on that, given the discount is still there.
It's actually closed. Do you want to take?
Yeah, I think the sector and ourselves are at least fairly pleased. I think if you told us 3 years ago the discount would be where it is in March 2026, we would have laughed. So it's been nice to see the sector re-rate. Obviously, why is that important? We're certainly not trying to manage the share price. We're trying to manage a business, and hopefully if we're doing the right things, the market will reward you. But you also need a bit of luck and a bit of you need a cycle to go well as well. So from our perspective, we do watch the share price, but the position we're in at the moment, where the share price would be important, would be the ability to issue obviously new shares to raise fresh capital. Just given our pipeline, and I think that we can do it judiciously with debt at a relatively low cost at the moment, we'll do that. The other thing with shares are, once you issue them, they're out there forever. You have to service them forever. So to us, it would be an extremely important consideration before we thought about issuing shares. You might have a reason to do it now, but you need to make sure that reason is still there in 5 years and 10 years' time. In other words, that the assets that you've built continue to provide growth on that initial investment from that capital. So yeah, we're not looking at issuing shares at the moment. We're not too phased. When our share price was quite a bit lower, we did a small buyback back at the time, but even then we were also balancing a number of different objectives and constraints. And ideally, we'd rather put our capital in, recycle the capital we have, hopefully get some asset growth, retain some of our income, and use debt conservatively to grow this portfolio at this stage where we are.
No, maybe just to add on what Peter's saying, it's our focus is really on, and you also pick it up in our long-term incentives, is the profit margin of the business. You know, so it's growing the yield of the business towards our NAV share price. You know, so we focus on what is our NAV, what's our distribution, what is our yield to that, and are we growing into that? The developments, is it sustainable? Is it, you know, is it long-term in nature? Does the growth come? Are we disciplined in cost? So we really focus on the fundamentals of the business, and we keep on, you know, as the bit of the tailwinds, the re-ratings will happen, and we definitely closing that margin, and that's all because of we're sticking to our strategy, our debt strategy, and our capital allocation strategy, and we'll close the gap. We keep on closing the gap with fundamentals.
I've got one in my DMs that I think is worth us dealing with quickly. So interesting one. In terms of how it works with government policy and stuff around, for example, the waterfall development, do you need to think about stuff like low cost and affordable housing, or are you kind of able to build out the precincts the way you think they should be? Sorry, I'm probably wording it badly, but it's outside of my wheelhouse for sure. Just a very interesting question. You know, is there anything there that you need to think about?
Yeah, definitely. And it's a very good question. So when we applied for the rights, I showed you that big diagram or that layout of the grade, you know, the whole Waterfall City. So when we got the rights, you take everything into account. So you take into account the Baldwin units, the Niekerk units. So you take all of the development into account, and if you look at that, you're actually servicing everything from low-cost units all the way to premium units. We don't have a lot of residential rights that has been approved as part of that basket of rights. And part of our basket of rights is we don't need to comply to low-cost housing. But there's other developments that the landlord has done and undertaken with other developments that has catered for the specific needs from a government point of view.
I'm just checking. Sorry, I'm just checking my DMs. I saw one popping up there. No, that's all for me. Unless the ghost has got a final question.
I've got one last one because we've got a few minutes, so I will jump in if that's all right. Something that I've been finding interesting when I read about all of the property results actually is around lease escalations. It always looks like it's quite a bit higher than official CPI, and we all know official CPI is that specific basket. I guess the question here is just the extent to which your inflation as a property owner differs from CPI, which is presumably driving these escalations. I think that's good for investors to understand.
Yeah, it's a good question. That's when our discipline comes into play. Is how low can we get our costs to grow? There's definitely some structural issues that we cannot control. For instance, the enforced security guard increases on an annual basis, much higher than CPI. So we are exposed. Also, rates and taxes increases, electricity cost increases that do not. Insurance have been extremely over the last few years. So we definitely don't track the 3%, but as a business, we try and be as disciplined as possible to keep it as low as possible. And then our lease escalation must beat our cost escalation on an annual basis so that it's not a negative jaws, but a positive jaws we create in our NOI growth.
But I think the actual answer is, as you say, CPRs. I don't think anyone's business is only CPR is a construct which is useful, but I personally don't know anyone's businesses where the costs are only going up by CPR. Sadly, it's a challenge.
Well, thank you to everyone who chose to spend time with us today, and a special thank you to Jackie, Peter, and the investor relations team at Attacq for making this time to support the platform and to engage with retail investors. Thank you very much. It's always a good discussion. Our next session of Unlock the Stock will take place on Thursday, the 9th of April, and that will, it's a returning company to Unlock the Stock, which is CANS. So we look forward to everyone joining us for that. Please look out for the invitations. That is all from my side. Goodbye.